Welcome to Share Talk, the only podcast where investors come first.
Today we have Andrew Bell, Executive Chairman of Red Rock Resources, which is a natural resources development company listed on the A markets. Morning, Andrew. How are you?
Good morning. I'm very well.
Okay, good to hear from you again. Do you want to give us an update on how things are progressing in Red Rock?
Well, yes, I was actually saying to somebody just earlier today that I cannot think of a time when Red Rock has been in better shape. We have now three live significant sources of revenues and cash flow, one from manganese, of course, one now from ferrosilicon, and one from gold, which is building up. So that's an extraordinary stability, and we've got more than half the market capitalization in cash. And I see all these revenue sources as ones that will become more significant over time.
And I suppose with diversifying your sort of portfolio with different minerals, that's going to cover yourself in case the price increases or decreases, anything like that. Which bit of news would you expect to be coming up?
Well, I think it's probably pretty obvious to anyone who looks at us that we are slightly overdue by a matter of days, probably. Some more news on the gold, in that we're due to announce, obviously, that we've been repaid our promissory note of 0.75 million plus interest on the promissory note that we got as part of the sale of some of our interests in gold in Colombia. So that is a piece of news coming out fairly shortly, you'd expect. Also, every quarter, and therefore due now, there's the royalties, the gold royalties get paid to us, and that's begun to build up, so you'd expect to have something on that. On the ferrosilicon, that process of commissioning the plant and building up to commercial production has been underway now since a month ago, and so within the next very short period, you'd expect us to be saying something about full commercialization and sales contracts there. And then mid-June, at the manganese, Tshipi in South Africa, Tshipi Entley, that company will be having a board meeting at which they review the situation, and if they feel they've got enough cash, and given the manganese price, I expect they would feel they've got enough cash, they will probably make a distribution decision, which will then be reflected by Jupiter and announced by Jupiter very promptly, because Jupiter is now a listed company. When Jupiter announces it, we in turn, at the same time, would announce as well. So that will be whatever the dividend decision is for September. So I think, even with those production assets files, we're just coming into a news-rich period over the next few weeks. But we also have, remember, assets that are not yet in production. And I think we can expect news flow from them too over the summer.
Just going back to Jupiter there, when they listed on the ASX, I think you did offload about just over 4 million, nearly 5 million shares. And but you still got a big holding there. Is that the strategy that you're going to have with them?
I think we'd like to continue holding, because we are holding part of the longest life, probably cheapest producer of manganese in the world. The 95% of manganese goes into steel making, but that little 5% that is on top of that actually has to accommodate the growing demand for EV batteries and other electric batteries. And we think that'll be a growing demand and will become reasonably significant over a period of years. We also think that the large amount of world production at the moment that is Chinese production for the domestic steel industry is on a long-term decline, so they're having to import more. Whereas two of the main competitors as open-cast manganese mines are going to be running out in 10 or 12 years. So prospects very good there.
Okay, so you've got quite a few things on the go, and a few that it sounded like you couldn't talk about them at the moment. How's it looking financially?
Well, financially, we have an embarrassment of cash In fact, for people who, for example, repaying the promissory note, we're looking at that and saying, goodness me, we're going to get, we have been getting promissory note paying 5%. We're just about to give them a whole lot of cash where it would be hard to get paid as much. Do we want to take some of that cash in shares or something? So we're at the stage where we're looking for ways to hold things that will give us a better return than cash. So we are well provided for our future needs. And obviously, we won't be coming to the market to raise any funds. Indeed, I'd have thought that in a few months' time, we might well be looking at ourselves and looking at the market and wondering how we can start returning cash to shareholders, because we want to do that once we can see that we'll be able to do it on a sustainable basis rather than as one-off.
So you're looking at dividends then?
Yes, and that's the next step in our evolution.
That's a fairly impressive place to be on the AIM market, in that situation.
Well, I think we're in an impressive place to be because people can say bad things, about the last few years when we've been in the bear market on AIM, small illiquid stocks in the mining sector, which was out of favor. But we have come through that and positioned ourselves as having multiple and multi-commodity revenue sources, like a small mining conglomerate or mining finance house. I don't think there's another company of our size on AIM, or hardly another company on AIM, that has that particular profile. And to have got to that, I think it's unique. I think this is looking an extremely good company, and with very, very good prospects.
It's good to hear, Andrew. I'm just going to ask you one more question, which relates to Trump being in the news recently and announcing the tariffs on steel. What impact do you think that's going to have?
Well, obviously, Trump's measures have been to protect the U.S. steel industry. Direct exports of steel from China to the U.S. may be quite low, but with China producing more than 50% of the world's steel, that just means some of their surplus production is spilling over into other markets. Now, that is having an overall depressive effect probably on prices, and I would imagine the U.S. government's assumption is that by the measures they're taking, they are going to force some of these other trading blocs or countries to take their own protective measures. Now, in my view, the EU has never been backward when it comes to protecting itself. And I think the European steel industry, which after all is the main customer for steelmen, will protect itself. And so that's not necessarily going to be bad for us. The measures that have been taken in the US.
Oh, it's a good insight to have, and good view of it. Thank you, Andrew, for taking the time. And as you said, there's quite a bit of news coming up in the future, so we're going to surely hear from you soon.
Thank you very much.
Thanks, Andrew.
Thank you for listening. Remember to visit our website for more news and other podcasts at www.share-talk.com.